Welcome, everyone, to the Jacksonville Real Estate Market Update Q4 2024. We made it, GC.
We have.
We're
here.
I cannot believe this year is almost over.
I don't even know what to say.
I don't know what to say.
Yeah, but we're here.
I don't know what to say, but this is our biggest show that we do. It is also the one time in the quarter when we invite clients, we invite other investors, we invite the whole ecosystem to be here. So we welcome you. If you don't normally join us here on Tuesdays at 12:30, we do a weekly show called the Not Your Average Investor Show, where old GC here does his usual data perspective, and we tie it into current events. We talk about the things that are important to investors these days, and we always kick it off in a particular way. And that is, I am your host, Pablo Gonzalez, and with me, as always, is the man that I affectionately like to call GC, because he's a great co-host, because he's got genius concepts. He knows how to generate cash flow, and his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
And right after that, we kick into another little tradition that we have around here. GC, what do you think that's called?
That's called the roll call.
The roll call, baby. We've got, the mystery man checking in from Kuwait
Danny
first.
Davies,
Danny
number
Davies.
one right there.
Thank you for your service, sir. We have our leadoff hitter batting second today,
John Henning.
We got Christopher Lee from Fernandina Beach checking in.
Chris.
We got our community manager, Joanna, making sure that anything that you need, you can just chat with her right there in the chat. We got Le Monsieur. Just say his name. Just say his name.
Reggie Fonse.
Oh, Reggie Fonse from Leland. Good to have you, Reggie. We got the MVP. Everybody's heard of him.
Mr. Lee Bishop.
Mr. Lee Bishop. We got the legend of Charlottesville, Virginia, the man with a hockey arena named after him, the number one referral source for JWB.
Roger Voisinit.
Roger Voisinit. We got Susan Parker in the house. Good to have you, Susan. We got T. Castor back from Tennessee. Tennessee Tea.
Tennessee tea.
Tennessee tea.
All right, Tennessee.
All right, I've got that sweet tea in Tennessee.
There we go.
All right, good to have you. Yeah, T. Caster. We got Fritz Brown in the house, my portfolio manager.
There we go. JWB represent.
Fritz, good to have you. We got the Shaw man from the West Coast.
Nadine Shaw.
With his good morning, good afternoon from the Pacific Northwest. We got the rock star from Rockland, California.
You switched it up on me. I was going to get excited about my fellow Steelers fan.
Here we go.
There.
Here we go.
All right.
Here we go.
The rock star, Marie Rockoff, of course.
Oh, Marie Rockoff is the rock star.
I thought so.
I was just going with Lewis.
Oh,
yeah. Lewis, good to have you, buddy. Big win this week.
Go Steelers.
We got the ringmaster in the house.
Andrew Barnhill.
We got Charity Graham back in the house. Good to have you, Charity.
Hey, Charity.
Another teammate, Christian Mendoza in the house.
Absolutely.
Good to have you, Christian. Anya Sanchez.
Another teammate.
Good to have you, Anya.
Anya.
We got the world famous musical score composer from Long Island, New York.
John Williams.
John Williams. Good to have you here as well. We got the patriarch and matriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Moline. We salute you. Who else we got in here? We got the Maven from the mountains of Denver.
Ms. Leslie Wilson.
Miss Leslie Wilson. We got Layla Powell in the house, teammate.
All right. Gregg.
Said your name in a minute. Hello from the
missed him.
Right, the mountain man's been gone for a minute. Hello from the isolated, remote mountains of Colorado, where the big question here is who won the election.
Okay. Not going there.
Ooh, hot potato. All right, Michelle John from Jacksonville, Florida. Good to have you, Michelle. We got our Sean from Destin, Florida.
All right, Sean.
Beautiful little piece of the country. Sean, welcome. Jason Oman from Minnesota in the house.
New name?
New names. We got a bunch of new names.
It's amazing.
We do this every week. Make yourself comfortable. Meet somebody in the chat. Everybody here wants to be your friend. We got speaking of everybody wants to be your friend, the fairy godmother of the Not Your Average Investor community.
Miss Jen Filson.
Sowing those real estate investing dreams everywhere she goes. She's hosting a meeting in lovely Monterey, California, November 17th at McGrail Vineyards. Her information's in the chat. Check her out. We got Right Along Raj in the house.
All right, Raj Bantu.
Scott Skelton from A2.
All right, Scott.
Ann Arbor, Mission. Good to like two.
A2.
A2. Scott Skelton, Ann Arbor, right? Like to the S2. We're going to call him S2.
I love it.
I like it.
Fantastic.
Scott, good to have you, my friend. Who else is here? Melissa Chin in the house from Jacksonville. Good to have you, Melissa. Dejavier Speller.
One of my best buddies. My best buddies. He and I studied abroad in Spain together. 20-something years
Sevilla?
ago. That's right.
Oh, mucho
He's a
gusto.
current client and a good friend.
I love that, man. Dehav, I studied abroad in Sevilla too, just a year before you guys.
Yeah, don't try to be cool like me and Dion.
I made it cool. John Evans is in the house. Good to have you, John Evans. Brian Dayhart is in the house. That's a new name as well. Ed Ortelli, first time as well. Ed, make yourself comfortable. Alan Wolf, Alan and Hui in Cincinnati.
Fantastic.
Couple of new names, a bunch of new folks.
Wonderful. Thank you all for being so bold and courageous and saying hello in the chat. I know you're going to make a ton of friends here.
Mi hermano cubano, Rene de Hombre.
Oh, wonderful.
Yeah,
fantastic.
Rene, good to have you here, my friend. Que vola. What else do we have in here? Okay, cool. This is a really good.
Yeah, we might go on for days.
Jillian Vega, shake them dice and roll them. Let's go.
I love it.
I love it. David McKinnis from Cabo San Lucas. I'm not jealous at all. Our regulars, Gary and Rosalind Riley from Marietta, California. We regard you. We got Milady Jack Chata. We got Eddie Harris from Hotlanta. Who else? I'm just gonna stream it. Oh, we got El Gran Amigo. Buenas tardes desde Duval.
Bill Shields.
Bill Shields. Good to have you. All right, cool. We're gonna be here forever. Patrick Muckery. Just a lot of
JWB teammate right there.
Don't tell his boss. Don't tell his boss that he's here. Jeff Marincow from Maryland. Jeff, good to have you back as well.
Spoke with Jeff last week.
Yeah. Robert Herman, Marie Rockoff, the rock star.
There we go.
Now we got it. All right, cool. Kate Sutherland. Always gotta welcome you in here.
There we go.
Okay, that was 7 minutes of roll call. This is obviously a heavily attended show. It is also a heavily thought about show, GC. You carry this show with you on your shoulders from quarter to quarter. And just kind of like, what are you thinking as we go into this one, man? What's on your mind?
I think one of the best opportunities for, this show is an incredible opportunity for me. And one of the best things that comes along with this opportunity is to sit back, think about where your headspace is as an investor, and then think about what my team is doing and working towards on an everyday basis. And the first thought for me is always just this insane sense of gratitude. And I was just sitting in TMM today, and we have, 100, 130 folks sitting in our team meeting. Yeah. And I was sitting there and I was looking around the room and I was just like, you know what? It's such a gift to be surrounded by people who believe what you believe, to be connected by a common mission, to be a part of something that's greater than ourselves. And I think that same thing is a part of our Not Your Average Investor community and our client base. And I remember being an entrepreneur starting out and just thinking to myself, man, you know what? I feel like I can do something good in the world here. I feel like I can really do some good out here. I just hope one person believes that I can. And one person was able to take that leap of faith and to follow the model and the mission that we have here. And so my first thought as I was preparing for this is just gratitude. Thank you to all of you for being here. Thank you to my team. Thank you all for helping, the four of us who own the company here. It was just a dream in the beginning to start to do something that can make an impact. And so to sit here and think that we have hundreds of folks that are taking an hour out of their day all over the world to tune in, to listen to us and to our thoughts is a special gift. And it's never lost on me. So thank you guys from the bottom of my heart.
I love it, buddy. I can't wait to hear your thoughts about it. Before we get into that, GC's put up a bunch of stats here and a bunch of great info. And if you want a copy, you got questions, text Tiara. She is just waiting for you to text her today. She's happy to send you this presentation so you can follow along now or later or whatever you want to dive back into it. But she would love to answer any questions that you might have about getting started, any kind of FAQs or something that use her as a resource to get some questions answered. If anything isn't really, really clear, text her at 904-293-0341. It's Tiara. This is not a bot.
No,
so be kind.
And Tiara speaks with thousands of investors every single year.
Yeah.
And so if you want to be able to lean on somebody who has been through this and has helped thousands of investors take that step that many of you are thinking about taking, reach out to her, start that conversation, and you'll enjoy talking to her. She's wonderful.
904-293-0341. GC, you know what's on my mind?
What's that?
I feel like we are about to enter one of the more precarious nights of the year. It's a joyful day. It is filled with food, family, and football.
Yes.
But as we are in this very difficult time of our country, right? Our country, there's some intense stuff going on. There's wars overseas. There's an election that everybody's talking about. And us as real estate investors, when we get around the table for Thanksgiving, I'm sure we're going to have our conversations with our family, with whatever differing viewpoints, whatever is happening. But as a real estate investor, I feel like every single time that I'm telling somebody I'm about to invest more in real estate or that I own 5 properties, it comes with a barrage of questions.
Yes, absolutely.
And those questions are not always like, oh, that's so cool. How can I do it? It's like, oh, are you crazy in this economy with war on the loom? All these kinds of different things, right? We will be not just challenged on our beliefs and stuff like that, but we will definitely be challenged in our financial decisions as not your average investors. So I feel like this is the perfect opportunity to have this quarterly market update. Call this one the Thanksgiving prep, the amuse-bouche of Thanksgiving and thought leadership around real estate. What do you think, GC?
Well, I think so. I mean, I would say, normal Thanksgivings. We're all prepared for all of the wonderful things that come along with it, but there's always some questions that come along that, might be a little bit more on the, hey, like, what are you doing side? In real estate, I think that it lends itself to that more than other maybe investments, because it is a not your average approach, especially when you're building for a better retirement. This year, there's a whole lot of differing opinions. So I think there's not a better time for us to come together and understand the state of the investment world, the state of the real estate market here in Jacksonville, how it relates to the greater economy. And I think it's going to empower you. Should you decide to get in some of those conversations, you're going to have some perspectives and some data and some analysis here that the average investor might not have. And it might serve you well if you want to get into a debate.
Amen, brother. And as we get into that, I know there's a lot of new folks on this call. There's something that happens when people first join in. They want to get in the chat, but the chat is defaulted to only talk to hosts and panelists. If you want to share with other people, you got to change that little top button to everyone so everybody can see it. So Michelle, you wrote something really, really nice in the chat here saying big thank you to the JWB team, Sam, Raven, Fritz. So far, my husband and I just closed on our first 6 investment homes, and everyone made it so seamless and easy to do so, including all the partners from lending to closing. That's a wonderful
cool
sentiment. Yeah, really nice thing for you to share.
Wish I could give you a high five.
I read it out loud because you only led that to me. But as we continue, I'm not going to be able to read every message, right? So if you want other people to see what you're writing, make it everyone. GC, talk to me, man. What are people thinking about? What do we need to prepare folks for?
Yeah, well, let's do a little bit of kind of recap from the last quarterly market update. We talked about how we were in this state of fear, right? Many times you're either in a fear position or it's a greed position. It doesn't always go to that spectrum, but as a marketplace, as investors, we're largely either in one of those two camps. And there's ways to act to your best benefit when the mindset in the investor space is more fear laden, or if it's more greed, right? If everybody's trying to make, a buck here. And last quarter, we looked at some headlines that were really fearful. And we talked a lot about the impact that those headlines and the talking heads and the noise had to create fear. Well, guess what, guys? When I'm thinking about the headlines for today, we're right back here in this fear market.
Yeah,
I think you all would agree. We're gonna lead into some of these headlines that I think are causing the most fear in the minds of our investors out there, our clients, our not your average investors. I think you're all are looking for some answers in some places. And so I tried to dive into we'll call it the meatiest topics. And, so of course the election is still in the minds of many folks. Geez, 1 or 2 quarters now, we've been talking about how elections were going to perform. Well, I'm going to show you how housing prices have performed in this election cycle, and of course continue it on from here. We're going to talk about the
hurricanes, man. These
Thank
hurricanes,
you.
yeah. Everybody, everywhere I go, I've been traveling a lot. Everywhere I go, the first thing people are like, "How do you deal with these hurricanes? Is it going to destroy Florida? What's going on?" For sure.
Yeah, and it's we've heard it on the phones with our folks on the sales side. I mean, that is a common question. And there are even some clients that are making decisions based on what they think they know about hurricanes and how does it affect the market. I mean, look at headlines like this from the New York Post. Florida housing market crumbles. Homeowners struggle to sell amid rising insurance costs and storm fears. I mean, how could you not be scared if you don't have access to this type of information? So we're going to dive right into that. I think you're going to be surprised at some of the data there. And then lastly, we've been hearing about rents plummeting. Jacksonville has made some headlines for rents declining and rents plummeting. I'm going to separate the noise from the truth there for you. And we're going to talk about how to act in the market, which we have right now as far as how rents are going.
Sounds good, man. So what is the foundational reason why you want to get into these fearful headlines? You called it a fear. We're in a fear market right now, right?
Well, and here's what I try to do. I think we all feel the fear, but I don't think people make the connection between what is the biggest problem with being fearful. And the most natural reaction when people are fearful is to do nothing. And people feel like doing nothing is an okay thing to do. But what I am trying to help all of our clients, all of our not your average investors understand is that if you buy into the fear and you do nothing, there is a huge opportunity cost to it. It may be uncomfortable to take action when there's a lot of noise and fear out there. But if you look at some of the best investors that our world has ever had, they have talked about how it is important to take action. And the reason is because if you just sit there and you do nothing, you miss out. But if you just take action, let's say you don't get it right. Let's say you make a mistake. That's still a better movement because you can then take another corrective action because doing nothing leads to inactivity for long periods of time. And ultimately that opportunity cost is really, really great. So I looked up and last quarter, for those who joined us last quarter, we talked about Warren Buffett, because I think this is just a shining example of how to act as just a world-renowned investor. How does he think in moments where there's fear and noise in the system? Warren Buffett, he of $136 billion in net worth, Oracle of Omaha, somebody who is incredibly generous, by the way. And the quote that he's probably most known for is that he says, you want to be greedy when others are fearful. You want to be fearful when others are greedy. Mm-hmm. It's that simple. And I thought it was interesting. You know, he still lives in the same house that he bought back in 1958.
He is famously frugal, man.
Famously frugal, but also very giving. He's pledged to give away 99% of his wealth. So when I hear that quote, to me, listen, I don't know him to be a greedy man, but I think he's helping to prove a point here. When he's talking about you want to be greedy when others are fearful, he's talking about you want to be ready to take action when others are fearful. And so we talked about his example last time, and I said, well, let me give you a few other examples of people that I think are just wonderful leaders, wonderful success stories. And so then I went to Oprah Winfrey. I think she is just incredible. She's the first Black female billionaire, estimated net worth of about $3 billion.
She's done pretty good.
I mean, she has changed so many lives. Yeah. And here's what she thinks about the idea of doing nothing, right? And how to manage risk. She says that she believes that one of life's greatest risks is never daring to risk. She's saying the opportunity cost of doing nothing is the greatest risk. It's the greatest cost of all. And I wanted to share more stories too. So I think of Warren Buffett. I think of Oprah Winfrey. They're kind of like on my Mount Rushmore of just wonderful leaders, investors, people who've overcome great odds. And so I started to think about my third, who would be on the Mount Rushmore here.
Who would that be?
And it went straight to Ashton Kutcher.
Ashton Kutcher,
strong of the movie Dude, Where's My Car?
Yeah.
Okay. And Ashton Kutcher says the only thing that matters is that you take action. The reason I chose Ashton Kutcher here is to bring a little comedic relief here, because obviously his movies are classics, by the way. But what maybe you don't know this, but Ashton Kutcher is actually a very successful investor. He was a very early stage investor in Uber and Airbnb, and he's worth $200 to $300 million. And the majority of his wealth actually comes from his investments. And so if you start to think being that type of an early stage investor, there's a whole lot of people that tell you you're crazy. There's a whole lot of fear that you have to navigate. And so I think it's interesting, worth noting that he specifically talks about how you need to take action in moments where there's fear as well. So we can learn from Warren Buffett, Oprah, and don't forget about Ashton Kutcher.
Don't forget about Ashton Kutcher. He's not living off that 70s show money. He's living off that Uber money.
That is true.
Let's go.
That is true. Yeah. And then I also like to point out, how much does this inactivity cost? And last quarter, I broke down an analysis of how much it might cost in one realm. Well, I wanted to give you a different perspective. I said, listen, from 2019 till 2024, obviously real estate has done quite well, but there have been a whole lot of articles that thought that the real estate crash was coming. And so I said, well, let me just type in real estate crash from 2019 to 2024, and how many articles popped up? And about 52 million articles popped up from 2019 to 2024.
In 0.20 seconds.
Yeah, in 0.2 seconds, right? And the first one here is very similar to all 52 million, which is the housing market is a bubble full of fraud and it's going to pop. If you were here the last quarter, I went through every single year and talked about how the talking heads and the pundits out there were saying that real estate was going to crash, and I put an analysis together. Well, let's just be real simple. If you listen to any of these articles in 2019 and decided to pass up on buying just one property, a rental property in Jacksonville, it would have cost you over $137,000, just one. And many clients, many not your average investors, were able to work through that fear, channel their inner Ashton Kutcher, and take action. And they bought many, many properties and created major, major amounts of wealth for them to accomplish their overall goals. So that's why this is such an important call. I feel like you all need more data and perspective at a moment where there is a fear market, even then when times are good. And that's what I want to lean into as we go through this today. It's a different way of doing it. It's not buying into the headlines. It's seeing the headline, thinking about it, then going to the data, and then adding in the perspective of managing over $1 billion of real estate now for about 18 years.
I hear you, man. I love this term fear market, right? Because it's while in other markets we talk about bull and bear, right? Like it feels like in real estate, it's just like, when is the crash coming and when is the right time? I've never heard anybody call a real estate market a bull market. I've never heard it.
Right.
I've never heard it.
That's crazy,
Ever,
right?
ever in my life. It's always been like, no, not right now, because this is going to happen, or at least post Great Recession.
Right.
Right. So it's like this idea of labeling it a fear market, right? Like I think in the 5 years that we've been together, there's been maybe 2 or 3 quarters where the media in general is like, yeah, rental properties, that's what's up.
Yeah.
And I don't think that happens very, very often, right? So like labeling something as like you're getting marketed fear, you're getting, like we're in this like stage of the economy. I think it makes a lot of sense. And again, I have sat here at this, not this throne, but like this chair here as the Lord of the Not Your Average Investor Show community, and seeing you kind of like talk through not just facts, not just stories, but like data plus perspective of somebody that's been doing this for 19 years, somebody that's been around since before the Great Recession, that has way more gray hair today than he had when I first met him.
That, huh?
And let's put this gray hairs to work, bro.
Let's do it. Let's do it. All right. So let's dive into the first fear here. And the first headline that's getting a lot of run right now. And it's against the backdrop of the election. Do elections have an effect on real estate pricing and sales volumes? This is going to be a little bit of an update because we did talk about this last quarter, but we're going to talk about where this is going from here as well. So to bring all of you up to speed, last quarter, we debunked the myth that real estate crashed during election cycles. And I shared some of the same data with you that home prices went up in 7 of the last 8 presidential elections. The only one that it didn't go up was the Great Recession, because real estate caused that recession. Every other recession has been different. And so the punchline was basically whatever your real estate market was doing prior to the election is going to continue during the election, and it's going to continue after the election. And so I wanted to give you an update here on pricing in Jacksonville. And guess what? That's exactly what's happened. Year-to-date pricing in Jacksonville is up 2.6%. That's through October data. And that's not noteworthy because this happens in almost every election cycle in Jacksonville. Real estate prices, of course, in Jacksonville have appreciated every election cycle since 1982, the only exception being 2008. So you can see in 2020, we were up 6%. In 2016, we were up almost 11%. In 2012, we were up 2%, even coming off of the Great Recession. I guarantee you there were a lot of articles and talking heads talking about how real estate was going to crash in every single one of those election cycles. So we got to take that information and then go to the data. And this is what the data says, that real estate pricing is not affected by election cycles.
Got it. What about sales volume, Jason?
So this is an interesting one. This is the little sprinkle on top here. So been hearing a lot of noise about how sales volume has fallen off a cliff. And so I wanted to lean into that fact here. And I pulled the data here. So from July of this year to October of this year, sales volume has declined about 19%. That is real. But what I want to share with all of you is that also is not noteworthy because this happens almost every single year from July to October. I just pulled some other noteworthy years. So in 2022, from July to October, sales volume went down 4%. But look at what happened with home price appreciation for that year. Right? Home prices appreciated about 10% in 2022. Well, in 2020, sales volume from July to October went down 11%. But what did home prices do? They went up about 11%. 2015, sales volume declined more than this year. It went down 20% from July to October. And in 2004, it actually went down 26% from July to October. But you know what happened, especially during those times of great appreciation, over double-digit appreciation in those years. So I want to lean into the fact that sales volume has declined, but guys, guess what? That happens almost every single year.
I remember when you first started talking about this stuff, like, it took you about a year or two in the show before you got comfortable starting to make like real predictions. And this was the first one that I remember you saying, it's like, hey, Pablo, I think I've got a prediction for you. Media cycle for the next 3 months is going to say this. And now every year you get to hit it. So
it's true.
Good to see that it's continuing.
Never changes. So
never changes.
So is it because of the election? Well, you guys can kind of see where we're going here. It's not because of the election. But again, don't just take my word for it. Let's go to the data here. So I went to Jacksonville, Florida's data, and I pulled all of the years that are election years versus non-election years. And I pulled the sales volume from July to October to see if there was a noticeable difference in the decline from election years and non-election years. And guess what, guys? There's no real difference. The difference is like 1%. Election years, it goes down 14% on average, and in non-election years, it went down 12% on average. And really, even if there was a correlation, look at what happens with home price appreciation, right? Home price appreciation goes up in both election years and non-election years. It goes up when sales volume declines from July to October. Let's see, I put the numbers together here. Oh, what was it? 96% of the years. Yeah. 96% of the years since 2001, sales volume has gone down from July to October. 96% of the years. The only year was 2012. I have no idea why it didn't go down in 2012. Yeah. But 97% of the years since 1982, home prices in Jacksonville have gone up.
Seems to be a pretty standard thing.
Yeah. Why is this getting so much run? Why is this making so many headlines? This is what I wanted to equip you all with, should you get some questions about why you're buying rental properties right now.
There you go. So big takeaway is pricing goes down since July. That's normal, right? So like you'll see a headline, you can discard that. What about this, GC? What's this data?
Yeah. Well, so here's just talking about what does happen every single year as far as pricing. So now I'm switching from the volume perspective to the pricing perspective. As I go through this data with you, I should point out that what I'm talking about is the macro Jacksonville market. You should think of what retail homeowners are paying for properties. Very different than what turnkey rental properties buy and sell for, right? The turnkey rental property market is very different than the retail space. So what I'm sharing with you is the retail market. But guess what? Home prices go down from July, and they start to go down in the fall and in December and in the winter, and then seasonality actually plays to where home values go down. The problem is that many people, and especially the talking heads, don't understand the seasonality component. So if you're trying to write headlines right now and you see sales volume going down and you see pricing going down from July to October, the convenient headline to write is real estate crash. Right. And throw in an election there where you don't have the data and you land on real estate crash. But I wanted to show you that this pricing month to month in fall and into winter, again, is not noteworthy. It goes down from July to January of the following year. And I put the data behind it. So in 2019, in July, our median home sales price in Jacksonville was about $250,000. Come October, it was $235,000. But then come next July, it's up to about $265,000. Same thing happened in 2023. And in 2024, going into 2025, the same thing is going to happen. And it's not noteworthy. This is normal. In fact, from 2015 to 2019, home prices declined in Jacksonville 23 times on a month-to-month basis. Yet the median home price appreciated about $90,000 during that time. 59% home price appreciation. And so the problem here is a lack of understanding by those who are writing articles like this. The generally accepted way to measure real estate markets is year over year. And that you have to do it that way because you'll draw incorrect conclusions due to seasonality. It will lead to whatever convenient conclusion you wanted if you measure month to month. And that's a big flaw in what's going on in the talking head.
Sounds like an error that's happened 58 million times based on your search.
Yeah, exactly. Exactly. So it's not noteworthy. What's going to happen? First of all, elections have very little, if any, effect on pricing and sales volume. Seasonality has led to both sales volume declines and pricing declines since July. And that will continue through roughly January of next year. And then guess what's going to happen?
What's going to happen?
The same thing I talked about last year that was going to happen. And the year before is that from January of 2025 to July of 2025, home prices and sales volume is going to go up. And it's because it's when people are outside trying to buy houses. The punchline here is that the market is normalizing and should continue to perform at the roughly historical rate of home price appreciation, which is just a shade under 5% home price appreciation per year.
You mentioned this about how this is the overall retail market and this isn't just the investor market, GC. This is, I mean, like, I think to the uneducated ear, you might hear this and be like, all right, cool. Then why don't I wait to invest in a rental property in February? What do you say about that?
Well, it comes down to supply and demand,
Mhm.
and it comes down to motivating factors to sell. On the retail space, you've got a homeowner who probably has left their house and maybe moved to another house. So their house is vacant. So they probably have two mortgage payments at that time. And it's also a time when there's not as much demand out there for buyers. So they're probably more willing to drop their price in order to get their house sold. They have much more motivating factors. Now, a turnkey company on the other side does not have those motivating factors, right? We have a client base that continues to buy and buy and buy and buy. But more than that, these assets are rented even before you guys buy them. So even beyond JWB, a really effective turnkey company will sell you the assets and they'll already be rented. So they don't have that motivation to be able to, fire sale properties because they have built-in demand if they've been around for a while. And then the payments being made every single month, sure, we'd like to sell it, but if it takes a month longer and we're able to still sell a market value, we're absolutely going to do that from the turnkey investor or the turnkey company and the turnkey provider headspace.
Got it. So as a passive rental property investor, there are no deals to be had in seasonality, right? Like it is just you buy the property, you start locking in that long-term home price appreciation.
Yep.
It's not going to change for you year over year because we're holding on for a full market cycle. At the end of the day, you just want to get in the game. You want to get your tax breaks in before the end of the year.
Right.
That's way more valuable than like, a bunch of other things. But like these prices are not going to go down for the passive side. If you're somebody that's like looking to move and live somewhere, you might be able to find a desperate homeowner that'll sell it to you, but it's not going to be somebody that has a stabilized asset ready to go for you where it's completely passive on that side. You'd be looking to like put work into it if you're going to have to do something like that.
Yeah, I think if you're looking at this from like retail homeowner perspective, this is great information for you to know that you're going to get your best deals if you buy houses in, October, November, December. So you should be able to get a discount off of market value simply because of seasonality working in your favor there. Very different with the investor mindset and the turnkey operator mindset. You can make an argument there's more demand from the investor headspace at that point.
Yep.
You mentioned tax savings and other things that are going to allow people to take more advantage buying before the end of the year.
Yeah,
people
do tend to buy a lot during the end of the year, right? To lock that stuff in. All right, cool. All right, GC, thank you. So that's the data per perspective. Update: elections still do not affect rental property investing when you're thinking about it from a full market cycle. Now, the next one that you're going to hit on, GC, is it's actually a conversation that I feel like I've been getting in on, right? Like I've been traveling the country, going to a bunch of different like trade shows and stuff like that. And people are like, man, 2 big hurricanes in Florida. You're a real estate. I'm going to property management companies, right? Like conferences, right? People are like, can you even deal, bro? Like, is that going to crash the market? What happens when the big one comes? All these kinds of things. So I'm pumped to see what you got on hurricanes, man.
Yeah, absolutely. Well, I just think, it's been noteworthy living through those 2 big hurricane hits here in Florida. I mean, you and I have lived in Florida almost our entire lives. Yeah. And so we're very used to major storms and hurricanes coming. It's unique to have 2 big storms that hit right back to back, and the pain and the heartache and the loss of life and the property damage has been a lot for us all to take in. And it's just so emotional. When you see images like this, I pulled images of some of the biggest storms that our country has endured. Our hearts go out to those who have lost loved ones and who have been through a rebuild. I've never been affected that way, and I can't imagine what that is. But there's just, I feel like I have an opportunity to help people lean into the emotion of that and be there for our brothers and sisters out there, but also understand how you can make wise investment decisions. Because if you let that emotion guide you, you might otherwise make a poor investment decision that might set you and your family back years, maybe decades from where you might have otherwise been if you didn't let that emotional component seep into your investment decision. And so my first thought as I started to kind of like lean into this, I was like, most people think, and before I got to the data, I probably would have thought that real estate markets that had been really severely hit by some of the biggest storms might have taken a long time to recover, if ever.
Yeah.
And so I said, well, let me go to the data. Let me see there. And so I started to pull the data of the biggest storms to hit our country. And then I went and I said, okay, well, 1 year later, what did the market look like? And then I said, well, 10 years later, what did the market look like?
Yeah.
And so I'm going to share that data with you to understand, do major hurricane landfalls really crater and crumble a real estate market?
Interesting, man. And, like we have the images here of the 4 hurricanes that you looked into. I think everybody has this image of Katrina, right? Like that feels like a market that probably got devastated. I remember Hurricane Hugo. It's like the first kind of, I had just moved here from Spain, and it was like the first one that was like threatening Miami and nobody worried about. And then I really remember Hurricane Andrew, because I was a 12-year-old kid in Miami and just completely like throwing us for a loop for many years, right? Like it felt like Miami didn't recover for many years from a residential standpoint. Probably about 5 years we talked about before and after the hurricane, which I'm sure they talk about in Katrina. And then recently, right, this hurricane in Punta Gorda a couple years ago that just went in there and ravaged Fort Myers and like that Casanova, Captiva area.
The most expensive storm in our history.
Most expensive storm in our history, man. So I'm curious to know what you found.
Well, the data really surprised me. I mean, sometimes I put the data together and I surprise myself. And so I wanted to share it with all of you. So here's the list of the biggest storms that I could find in recent history, and even in some not so recent history, either Cat 4s or Cat 5s. I included Katrina here because it was actually a Cat 3 at landfall, but we know how devastating Katrina was.
Yeah. And people don't know that Katrina messed up Miami real good.
Yeah.
Before it got to New Orleans. I was there, right? Like it went through the South Florida, and then it went and hit New Orleans, right? And like it definitely messed up Miami pretty good.
Yeah.
Yeah.
Absolutely. So I saw the year of the landfall, the city or the real estate market that was hit, and what happened to home prices the following year. And this blew my mind.
Yep.
Right. I'm going to point out a couple of them here. Katrina made landfall in 2006. Did you know that home prices actually went up over 5%? In New Orleans?
That blows my mind.
Blew my mind.
That blows my mind. Like out of all of these, if there's one that I'm like, no chance it recovered in a year or whatever, I would have put all of my money on Katrina.
Like my bet would have been on there was a lengthy recovery.
Yeah, like 5 years. New Orleans is crushing it now, right? But like not next year.
I was surprised.
Yeah,
I was surprised.
Yeah,
and then you see the following 10 years, is it performing along what otherwise would have been the trend for that market? And it is for Hurricane Katrina. In 2005, obviously 2005 happened. The 10 years after that was an up and down road. Wow. So the following 10 years, you had 8.5% home price appreciation. You don't see depreciation there at all.
I mean, it's 8.5%. 10 years, with the middle of those 10 years being the Great Recession after a ravaged hurricane. Like,
go back to 1992.
Yeah.
Hurricane Andrew.
Yeah.
Can you believe that the year after the year of the hit and looking 1 year later, 8% home price appreciation in Miami-Dade?
That's shocking to me.
Shocking.
That's shocking to me.
And over the
I did not get the sense that people were moving there. I did not get the sense that there was any economic activity out there outside of recovering from this thing for a full year.
So this is an example of emotion, of what makes sense to us emotionally versus what actually happens in a real estate market.
Yeah.
And that's why this data and perspective is important, because we can equip you to make great decisions, or at least take a reason to not invest off the table.
Yep.
I think that's the goal here. I mean, even Hurricane Hugo, which as a country, we're certainly unprepared for how to handle that one. Home prices went up 4% the following year and 40% over the following 10 years.
Yep.
So nowhere here in our biggest hurricane landfalls did we see any type of decline.
Yeah.
And certainly not crumbling, cratering, devastation from a real estate pricing perspective.
Yeah, true.
Interesting data. Now, why is that? Why is that happening?
I don't know, man.
Well, I didn't think about this until I started to do some more research. But if you think about what actually happens when markets get devastated, it comes back to, again, supply and demand. So a lot of supply of housing is unfortunately no longer there. So the supply is lower. The people that were living in those homes now want to live in the same communities. Yeah. And so now they are going to find another home largely in that same community. So demand actually increases.
And supply decreases.
Yeah,
okay.
This was a major unlock for me as I was going through this over the last few weeks.
Yeah.
So I think what we can do is put to rest this idea that if we would happen to get hit by a major hurricane in Jacksonville, that it would somehow crater the market and it would be a place that would lose money from a real estate pricing perspective. It just isn't shown in the data.
So that makes sense. Supply and demand. We're seeing that, right? I would say the other thing that people are asking me a lot, that have been asking me a lot as a Florida investor when I walk around, is about insurance.
Right.
And now that these hurricanes have hit, the next question is not even like, oh my God, our price is going to crash. We're like, well, what are you going to do about insurance?
Yeah.
So what do you say about that?
Well, again, there's emotion there too, especially since 2020 to 2022. As investors, we saw our insurance costs go up, and now we're like, oh man, the emotion of this devastation coming from 2 hurricanes hitting in a short period of time on the backdrop of insurance costs going up for those years, we must be in for a rough road. But when I asked questions like that to the people I trust the most in the insurance space, I got a very different answer. And so I wanted to share this with you. This is an email that and a text that I got from our good friend Whitney Ritchie, who is a dear friend of the show.
The original flow from Progressive.
The original flow from Progressive.
The person that introduced the 2 of us.
There you go. There you go. And a wonderful teammate and provider of insurance for a ton of JWB clients. You in the chat, many of you are saying that you know Whitney very well. She's always here to give. And so I said, what's going on with insurance? Should we be worried about where insurance rates are going to go going forward? And so this is how her and I talk over email. I said, hey, Whit, I'm just going to put your exact email on the screen. She's like, well, it's not going to be very professional, but I thought it'd be good for you all to see.
Give them the cliff notes, GC. What
yeah.
say?
Well, so basically what she said is, listen, her insurance providers are prepared for big catastrophic events. This is their business, right? They know that hurricanes come to Florida, just like natural disasters come to other places in the country. So there is a part of their pricing model that is built into expecting this. Yeah. And she also helped me understand the reinsurance market, which is basically just insurance for insurance companies.
Okay.
And so when a major storm comes, what's really on the hook there is the reinsurance market. The insurance company is largely limited to, for lack of a better word, a deductible there. So she said what we were not prepared as an insurance market was the rash of lawsuits that happened from 2020 to 2022, which were legal loopholes that were used to be able to get a lot of free roofs for a lot of people out there and put a lot of pressure on the insurance market that they were not prepared for. Those types of events and the glut of it, and the fact that we had like 10 times the number of claims in Florida than any other state for free roofs, was not something that's covered under reinsurance. Yeah. So it's the real risk of insurance premiums going up, according to Whitney and according to her, all of the people that she networks with, those who are in the know in the insurance market here in Florida and abroad, she says that we're feeling really good about what rates are going to look like next year.
Interesting.
Even though we just had these 2 major hurricanes.
Okay.
I was like, wait, can you give me some data? If I say that to the people on the show, they're going to say, I don't know. Can you give me an example of why you feel this way? And she said, well, look at what happened for Hurricane Ian. Hurricane Ian hit in 2022. It was the most expensive storm on record. Of course, the storms now are probably going to surpass that, but that is the most expensive storm on record. Insurance rates were largely flat and have actually seen some decreases from 2022 to 2024. Hurricane Ian hit in 2022.
That's right.
So, and what actually happened is we had 2020 to 2022 is when insurance rates went way up. That was actually a period of generally less hurricane activity. So it comes down to, what are these insurance companies prepared for?
Yeah.
They're prepared for hurricanes, right? They have the reinsurance market to continue to prepare them to make sure that they're solvent through that. Yeah. What they're not prepared for was that the legal loopholes. We have secured that. Whitney, I wanted to share this because Whitney's just a wonderful resource. Whitney, in addition to winning a lot of awards here, like Best Insurance Agency in Northeast Florida and Fastest 50 and Gator 100 award winner, she also was voted the Legislative Supporter of the Year for her industry.
Let's go with it.
She was up there in Tallahassee closing these loopholes for all of us as property investors. And so she's feeling really good about rates going into next year. She is thinking kind of like normalizing, right? And she does not have the fear that these 2 hurricanes are going to create large increases in insurance premiums. So music to our ears.
Yeah, that summarizes my favorite things about this show: data, perspective, and a little bit of insider secrets.
There you go.
Right?
Especially.
Like, go figure that these like actuary and math nerds know how to price risk for things that they know are coming and have 100-year tables on, but they don't know how to price the black swans of like lawyers rushing in to find a loophole, right?
Yeah.
Like, so yeah, it makes perfect sense that is the big risk. And it makes perfect sense that insurance companies are insured.
Yeah.
So, so take us away with the big data plus perspective takeaway.
Yeah, study of the most devastating hurricanes to hit the U.S. showing that home prices actually increased in the year following the storm's landfall. And this is due to that increased demand and lack of supply because of the storm. Those real estate markets continue to appreciate significantly over the next 10 years. Hurricanes, of course, cause a temporary disruption, but they do not alter the short run or long run pricing models for that real estate market. And here's the bottom line. Hurricanes should not be a deciding factor in which real estate market you choose.
Yep. Yep. Love it, man. I can definitely put that one to rest at my next conference. Can't wait for that, especially Thanksgiving dinner, because my sister lives in Bermuda now, so she gets way more hurricanes.
Oh, yeah.
That being said, now the next topic that's like, it feels like it's starting to bubble up, right? Like this idea that rents are starting to maybe like go down, or like there's kind of more days on market. I know that we made an announcement a couple of weeks ago in the chat that we were going to talk about it, man. I can't wait for you to address this one.
Absolutely. We're gonna address this head on. So you're hearing some noise, some questions. Are rents in Jacksonville declining? So let me give you the real data, and we'll mix in a little bit of perspective here. So single family rents in Jacksonville, Florida are up, but they are only up 1.5%. That is actually lower than the historical average, which is 3.6% rent price appreciation per year. But multifamily rents in Jacksonville and in many other parts of the country are declining. And a lot of these headlines that you're reading, I know there was one headline that named Jacksonville the market which has the biggest rent declines. What they're not explaining there is they're talking about multifamily rent decline. So single family rents are up. That's largely who we are serving here. We do serve some smaller apartment complexes on the multifamily side, but the vast majority of our clientele that we're speaking with here, you're all single family owners of rental property. So let's give this kind of like a label of where we are in the rental market. And against the backdrop of many years of historic rent price growth, right now, Jacksonville's rental market is considered soft. Soft would be, call it somewhere from no growth to maybe 2% growth year over year. And that's where we are this year. And that's also where we were in 2023, 2022, and 2021. It was a lot more, as 10% and upwards from there as far as rent price growth.
And I would assume that, this is if you're a multifamily investor, right? Like, and everybody likes to talk about how multifamily is more diversified or whatever. But as a multifamily investor, I'd be very concerned once you like segment this data out and see that these rents are dropping, at least in the short term. As a single family investor, my head first goes like, oh, okay, cool, no problem for me. But I would assume that there's some spillover. I'm sure that there's some crossover of family that is looking at a 2-bedroom, 1-bathroom house that now sees a 2-bedroom, 1-bathroom apartment and goes, man, with these rents dropping, I can definitely like forsake the yard for the next 2 years for my kids, or vice versa, or like 3-bedroom, 2-bathroom, or whatever, right? So it feels like that can, even though it's not specific to the single family home, it can still affect it, right?
It is. It can. And I wanted to put some data to that too, because I wanted to just talk about how did we get here? You all have been hearing about how I've been talking about how we are drastically undersupplied in housing. That's largely because I'm speaking about single family housing here, because that is our turnkey single family investor model. All of you clients out there own single family rental properties as a part of JWB here. So, but I wanted we've got to understand that there's a difference between supply in the single family space and the multifamily space. So after years of underbuilding, both single family and multifamily housing permits are now above historical averages. And I put the chart here so we could kind of see this in kind of buckets of activity, right? From 2007 to 2017, let's just start on the single family side. We had about 6,000 permits per year. That's below the historical average. Historical average is about 8,200. From 2018 to 2020, that's when we started to rebuild ourselves. Let's talk about like money coming into the space, and let's talk about people understanding. Builders were just so excited to build because home prices were going up, especially in markets where population was growing. So in Jacksonville, we were building 12,000 homes a year. It's 12,000 permits, but just call it close enough to that. Now, the fact that we were at 12,000, but the historical average was only 8,000 does not mean that we were overbuilding. What we have to start with is the fact that we are 7 million units undersupplied across the entire country. We started out way undersupplied. 2018 to 2020 was the first time we actually got above the number of homes that we needed, which was wonderful. Think about if we hadn't.
Yeah.
How much would home prices have gone up at that point?
Yeah.
Right.
Yeah.
2021 to 2023, you know, people are still building, builders are still building, money is still rushing in to build. And in 2024, we're still building 12,400 homes a year on the single family side. It's above the historical average. Now, multifamily is different, okay? So on multifamily, you have about 3,300 permits that get approved every year. 2007 to 17, we were below that. 2018 to 2020, we were above that. 2021 to 2023, we were over double that. And now in 2024, you're seeing a real scale back.
Yeah.
The difference here is just how quickly you can overbuild in single family versus multifamily. Because what's not shown here is the number of units. When you have 7,600 permits that are approved, those might be 100-unit apartment complexes.
Yeah.
Right? So you create this glut of multifamily activity and housing, which can really flip the dynamics of undersupply, oversupply very quickly just by economies of scale.
Yeah.
You don't have that in single family. So while it shows that we are above our historical average, we are still undersupplied in the single family space. So what's happening overall here is the glut of multifamily properties hitting the market in 2023 and 2024 is causing price declines in multifamilies. And it's also causing a softness in the single family market. And the reason is because of what you described.
Yeah.
For the renter population, there's a certain section of renters that will only rent a single family house.
Yeah.
There's a certain section that will only rent an apartment.
Yeah.
And there is a section that's in between.
Yeah, it's like a Venn diagram, right? Like
Yes.
they overlap some.
Yes.
Yeah, that makes sense. And
Exactly.
and then that's enough not to drop per se rents, but to maybe elongate the amount of, like maybe flatten them out, maybe definitely not as much of rental increases, and maybe like spend a couple extra days on market because they're like really debating this thing.
Yeah, it's certainly not declining. The single family market's not declining.
Yeah.
It's not a bad rental market right now, but it's a soft one. And you can kind of see how this starts to come to play. Again, of course, against the backdrop of home price affordability and rent price affordability being a major topic for our country and something that we all want to improve. You can see kind of how we land in this softness, but let's call it what it is. It's a soft rental market. It's not a declining rental market on the single family side.
Got it. All right. So let's look into the JWB data flywheel of like what that looks like as far as like the data that you guys do in your historical performance.
Yeah, I wanted to do that. And I wanted to take it a little bit bigger. Like, this is a different rental market that we're in right now than we were in 2022 or 2021 and vice versa. So how do I equip you all to make great decisions along with our team advising you in a soft rental market? And then really, how do you hold a property management company accountable in a soft rental market too?
Yeah.
So we'll start there, right?
How to make soft rental market moves.
There you go. Soft rental market moves.
You like that? You like that? It doesn't sound like a
such a
restaurant.
marketer.
I don't know.
You are so good. So here's the things that you should be holding your property management company accountable to: vacancy rate, rent collection, lease renewals, and you also want to have an eye on market to move-in days and average days on market. And so I put JWB's current performance, our historical average, and then to the best of my abilities, what the Jacksonville market is performing at or has performed at historically. And so we feel really good about our performance in a soft rental market here because of these stats. Our current vacancy rate is 4%. Our historical average is between 4 to 6%. So when I see 4% there, I'm feeling pretty good about it.
So 96% of houses of your 6,000 units at any point in time are occupied.
Yes.
All right.
Yes, absolutely. And beating the Jacksonville market and regular property management, out of the water there.
Yeah.
Rent collection continues to be really strong. I reported on this last show, but our last 3 months average is 98.4%. Our historical average is 98%. And I said somewhere between 90 to 95% is what a typical property manager in the Jacksonville market would get.
Cool.
Lease renewals.
So people in their homes are paying their rent. Exactly. It's not affecting that.
And they're choosing to stay because this is a greater value and a greater relationship they have with our property management team. Lease renewals are another sign of people wanting to stay. People like the services and the value. Over 75% of our leases have chosen to renew. At sometimes many have chosen at significant rent increases as well. Our historical average is 65 to 70%. And the overall market in Jacksonville is probably somewhere like 30 to maybe 50%. I think I'm being generous there.
Got it. So people are renewing their leases, staying in place. They're not like, if they're there and they're being taken care of, they stay happy.
Yeah,
Got it.
absolutely.
Cool.
And that's really important, especially in the soft rental market. You can imagine if
I would
we didn't
imagine
have
so.
75%, if we were like most other property management companies and only had 30 or 40% people renewing,
Yeah.
that would be way more houses on the market. That would lead to
True.
lower vacancy rate, lower rent collection. You can see how it all kind of works
Makes
together.
sense.
So we feel really good about that, but our eye is on this marketplace right now. We are putting more resources into the marketing and leasing and property management services than we probably ever had. And so I wanted to bring you behind the curtain here, just look at some metrics here that are on our minds and, you know, certainly are on your minds. I also wanted to lean into the fact that, you know, I pulled a report for the number of clients that have a long day on market home in Jacksonville with JWB. And I don't know what you call us now, medium-sized company. We're a lot larger than we used to be because in the beginning, it was just my business partners and I. And so our numbers have grown. We now have roughly 6,000 homes that are under management. Sometimes the percentages don't actually shine a light on the individual who might be going through a tough time. And so I wanted to recognize this. And we saw this in the WhatsApp chat. Yeah. We have 54 clients right now that have a home that's been on the market for longer than 60 days. 54 clients. And those are individuals that we care deeply about. This is a moment when your home is on the market for longer than 60 days. This is the worst part of the investment. We prepare every client that this happens. And if you hold on to these assets for years and years and years, like I do, and you do, and you've been through it too, right? It's a part of it, but it doesn't make it fun. And we try to lean in with compassion when clients are going through a tough time. And there's 54 of you that have had a property on the market longer than 60 days. And for some of you, it's a really, really tough time. You know, it's 54 clients. That's 3% of our total client population. So it does make me feel good that 97% of clients are not going through that. But I can tell you that it's absolutely on our minds and at the forefront to make sure that this doesn't become something that could ever get to a place where it could be a systemic client issue. And some of the things that we look at here, and we're not even close to that, but some of the things that we look at here are market to move-in days and average days on market. So I just wanted to share those data points with you. It is absolutely on our radar, and we are navigating this the best that we can, and we want to empower you on how to make great decisions alongside with us when we make a recommendation, because it is a soft rental market. Here's why we're doing this, to make sure that we can maximize your return on investment in a time that's not as easy to rent properties as it was 2 years ago.
Yeah, and I would imagine that for that 3% of investors that's going through it, right? Like, to me, I think of 52 days to 63 days, the life of the investor. What you're going through is like, hey, am I, you know, from the moment that this gets market, am I making 2 mortgage payments without rent coming in, or 3 mortgage payments without rent? You know, like maybe before you were thinking, am I making 1 or 2? Now you might be thinking, am I making 2 or 3? And you know, that third one, that's real money, right? So like that's a mortgage payment. So that threshold of 52 to 63 is particularly painful. So why don't we talk about what are the right things to do for the soft rental market, right? Like what are the soft rental market moves here?
Yeah, absolutely. Well, we're going to focus on prioritizing occupancy over rental increases. I think everyone can understand how that is a smart and prudent move in a soft rental market. Also, because we're coming off the backdrop of year-over-year increases the previous year and major year-over-year increases for years before that. So for many of us, those rental increases are a lot more than we expected if you had asked ourselves 3 years ago versus what we have today. So prioritizing occupancy, being comfortable with flat or even rent decreases on a per property basis as recommended by your JWB portfolio manager. And I'll even highlight rent decreases. When we talk about overall macro rents going up 1.5%, that doesn't mean that every single property has gone up 1.5%. Some properties, some of you experience rents that have gone up 5% or even 10%. There might be a situation where we might go to you and say, listen, based on our knowledge right here, right now, this is a good time for us to go a little bit below what you had before. And guys, that's okay. Like, nothing here is ever going to be completely guaranteed that it's always going to go up, right? Doesn't mean that your rents are always, always, always going to go up. And our job here is to make sure that we're maximizing your return. And so if we look at the market right now and there's a $25 decrease for rent, and that's the right thing for us to recommend for you, we're going to do that, because the thought of saving 1 additional month of vacancy And that $1,000 or $1,500 that we put in your pocket
Yeah.
versus the $25 times,
Yeah.
12, $300. Like, I want that $1,500 trade for you. And I think you want a partner who is willing to say that to you.
Yeah.
Because that's what you need as boots on the ground. So
Yeah.
we've been having these conversations with clients. I wanted to prepare you that might be the right move for you, even with a market that is going up in value on the macro side.
Makes sense.
I think what every client can do is make sure that they have a rainy day fund. We talk about this when we bring new clients on. All of these things that we've talked about, how it can take 60 days or 90 days to fill a home. This is all described on the front end for all of our clients. And we also talk about rainy day funds. So what I would recommend is setting aside 3 to 6 months of expenses for each property that you own. And that might come out to $3,000, $6,000 per property that you own, so that when one of these moments happens, which we have told you is going to happen, you're not going to like it, but at least the money is there.
Yeah.
For you to go ahead and take that, pay for that, make sure that you can handle those mortgage payments and not create stress at home, which otherwise it can. And lastly, this is a great time when things are, I guess, I don't want to make it seem like this is a dire rental market, right? This is things are still going up, but this is the first time we collectively have kind of dealt with this in a very, very long time.
Yeah.
Anytime that happens, a little bit tougher to navigate, get on the phone with us.
Yeah.
Right. When you have questions, you're not sure why things are happening.
Yeah.
This is a time to lean into your relationship with your JWB portfolio manager.
Makes sense to me, Greg. As you know, I have 2 properties that had a potential turn here in like November, December. I know that one got secured, another long-term lease, Katina. That one's doing great. My other one, I'm doing this exact thing, right? I'm prioritizing occupancy over increases. I'm letting them extend their lease for 1 more year without an increase. And I'm doing it exactly because of this advice, right? Like this idea that I'd rather just hold them, have them there for the next year. The idea of like going a year and a half or 2 years extra. I decided to just go 1 year to then have the option to then in a year be able to like raise it if I really, really wanted to.
Yeah.
Also build up some more coffers, and do that kind of thing. So, we're setting that plan forward, building the rainy day fund, doing that. The other thing that I think of when I look at this list of prioritizing occupancy over rentals, being comfortable with a flat rent and like building up the rainy day fund. If I was to be buying right now, I wouldn't be thinking that. I'm thinking that as somebody that already owns, but like adding a property to my portfolio, I wouldn't have to worry about that, right?
No, absolutely not. Right. And guys, let's just put this in perspective. JWB clients have way overperformed.
Yeah.
When you're talking about all of your profit centers, just even on net rental income.
Yeah.
We have way overperformed over and over and over again because rents have gone up way more than we ever expected. Right. And the vast majority of clients are still experiencing rent increases. So if you happen to be one of those clients where you have a momentary rent decline from what it was, guys, it's okay. Our focus here is delivering and meeting and exceeding your overall return on investment. And I know we're going to share some of the fun data that we have on that. So overall, clients should be feeling really good. But I did just want to make sure that people understand kind of the rental market that we are navigating right now. And to your question about buying today versus in a soft rental market, guys, it doesn't take a whole lot of time for a soft rental market to change.
Yeah. Yeah.
This is a blip on the radar.
Yeah.
And this investment is built for the long haul. And even we've talked about out of the most important profit centers, net rental income is the least important profit center.
Yeah.
Right. So you can still be cash flow positive even if you take a little bit of a discount. And that'll be the case for a small number of you out there.
Got it. I mean, that's exactly why I'm only renewing for a year, because I expect this thing to rebound and keep going up, right? So data plus perspective takeaway on the soft rental market, GC?
Yeah, I'd say keep a focus on the big picture. Rents have grown roughly 30% since 2020. Home prices have appreciated roughly 50% since that time. That is way more than you ever had on your evaluations when you bought into this asset class. As a JWB client, it's likely that you've earned double-digit return on investment each and every year, and you've built up your wealth by tens or even hundreds of thousands of dollars. And the short run and the long run fundamentals for rent price and overall home price in Jacksonville are very, very strong.
Yeah, like you said, it's a soft rental market, but the actual market is not soft, right? Let's talk about what the actual market looks like right now.
Yeah, so here is the traditional Jacksonville real estate market snapshot that many of you have been able to see quarter over quarter here. I show a pricing graph here of prices since 2001. And I help people see what a normal real estate market looks like in terms of home price appreciation. Those blue jagged lines are all the actual median home sales prices. And that red smooth line is what the normal market would have as far as home price appreciation in Jacksonville. That's a line at 4.9% per year. And the reason it's chosen as 4.9% is because that's what Jacksonville has done since 1982. And the theory is real estate is cyclical, which means home price appreciation levels are cyclical. You just have to hold on for long enough. And so over 10 to 20 year hold periods, you're going to find that your real estate appreciation is largely very similar to what the historical model is since 1982. And we're starting to see this play out over and over and over again. You know, in 2021, people were concerned that the market was going to crash. And I said, well, no, it's going up. And then in 2022, people were really concerned that it was going to crash. And I said, well, you know, what I see is normalization. In 2023, I said the same thing, and I'm saying the same thing in 2024. Normalization really means it's going to go up and down around that red line. And so what's going on here is it's hitting that line and it's kind of staying there. This is what a normal market does. And all of that noise about all the extremes that were going to happen were just that. They were just noise. Here's what October 2024 looks like in Jacksonville. The median home sales price is $352,000. As I mentioned, home price appreciation year to date is 2.6%. We have 41 days on market for a median days on market. That's the number of days it takes for a retail house to sell. That's really low.
That's pretty low.
By historical standards.
That's a quick exit for a house.
Yeah.
If you need it. Yep.
I mean, it's really low. So all these market articles talking about how the market's crashing and whatever. We got to look at the data. I can only be kind for so long.
I got it.
In regards to that.
You got told the market's crashing 59 million times and you got upset about it.
Yeah. Our months of inventory is 5.3 months of inventory. That is elevated from where it was a year ago.
Yeah.
We said it was going to be elevated. Between 6 to 7 is a normal market.
Which means 4.9% appreciation.
Exactly.
Yep.
So this actually indicates higher than 4.9% home price appreciation. And we would expect this number to go up. The next time I do a market update with you,
the next month of inventory.
Well, it's hard to analyze it month to month, but definitely the next quarter, when I do this, I would expect it to be higher than 5.3.
Okay.
So don't be surprised. And that's a normal market. And then foreclosures barely happen here. 2.7%, well below the historical number, which is 10%.
So these are all a bunch of great numbers in a vacuum, but I think a lot of people are coming to this call thinking about, does it make sense to buy in this market, right? So why don't you talk us through that?
It absolutely does. You know, Jacksonville rents are expected to normalize from 2025 to 2027. And even more than that, some of the leading indicators you should be paying attention to in a market that you want to invest in are median incomes and population, and those are expected to grow substantially. So I put the data here. You can see in 2025, we're expected to have 2.5% rent growth. 2026 and 2027, about 3.5% rent growth. The median household income in Jacksonville is expected to grow substantially. By 2027, we're expected to have our median household income at $94,000.
Okay.
Yeah, absolutely.
Yeah.
And the reason is because so many people are moving here and so many jobs are moving here.
Yeah.
So the population growth for Jacksonville is one of the highest in the country.
Yeah.
And it's expected to continue over 2.5% from now through 2027. And just to put it in perspective, the historical average for the US is less than 1% per year. So this is a place where people are moving to. This is a great thing for your rents and your home prices. And then if you're thinking about buying, just recognize right now you're buying assets that already have a renter in place.
Yeah. Yeah,
so
that's what we were talking about before.
Momentary blip of it being a soft rental market, you're not even going to notice it because your renter is already in place with a 2 or a 3 year lease. So this really is the same decision that it was, is the same decision you should have as far as buying a rental property. And, you know, we've talked a lot about this, but you know where my heart is here. Is it a good time to invest now, or does it make sense to wait? You guys know. We talked a lot about the opportunity cost of waiting. We've talked a lot about what the market dynamics show today. We've debunked a lot of myths about the election. We've debunked a lot of myths about sales declines and hurricanes. You know, the reality is that there is a large opportunity cost for waiting.
Yep.
We estimated between $30,000 to $40,000 is what it will cost you if you waited 1 year from today to buy that same Jacksonville rental property. you're going to have lower purchase prices today. You also would be missing out on all 5 profit centers of that equity buildup that you would have earned if you held on to the asset. And that's why it'll cost you 30 to 40 grand by waiting. All of these properties are already rented and positively cash flowing. And we do have 2 incentives now, which equate to thousands of dollars for our clients that are making these decisions here. We have a maintenance incentive, which we've had for some time now. It comes out to roughly $4,000 to $6,000 per property. And what it does is it's a payment that's made to you in your first statement that takes your first $4,000 to $6,000 of maintenance costs off the table. You literally get a $4,000 to $6,000 check. And there's no limit to the number of properties. We're doing that because interest rates are higher than we want right now. And so this will not be around when interest rates start to make that steady decline. We also have a 3-pack incentive. And so if you purchase at least 3 properties at one time or more, you are going to receive $4,000 to $6,000 per property that goes straight towards your closing costs. It's equal to 2% of the sales price. And again, no limit there. I had a friend that I helped build his portfolio. He bought 7 at one time. And so there was, roughly $35,000 that he had taken off of the closing cost that he otherwise would have had to pay for.
Not too bad. Not too bad. Laura McAlroy is asking any 2-pack incentives. She's a big West Coast hip hop fan. Any 2-pack incentives.
Oh man, I'll bring it to the marketing team. I'm a big Tupac fan too.
Yeah, me too. Me too. Only Biggie incentives over here, right? They're just big ones. So no 2-pack incentives. All right, GC. So let's look at actual inventory, man. Talk us through what it looks like right now.
Yeah, I want to connect the dots. This is the opportunity to invest in one of these properties right now. As you can imagine, there's more that we have, but they all fall just in line with this same type of pricing. What you see here is the model that we have built out and that all of our clients invest in. So if this asset works for you, just think that there's probably 10, 15, 20 just like it. You can see rates of return somewhere around 9 to 10% is what the market is bearing. Purchase prices somewhere around 238 on this one. So somewhere around 200 to about 280 is what your purchase prices will be. That means that you'll bring somewhere around $50,000 to maybe $75,000 to closing for your purchase prices and for your first investment. That would be per property. 3 beds, 2 baths, 1,230 square feet, already rented at closing. That is huge. That's why you do not have to worry about a little softness in the rental market right now. And if this is something that you're interested in, this would be a great time to text Tierra and JWB 904-293-0341. Start the conversation. If you're a new client, we're going to make sure that we get a good understanding of your goals, your resources, have a really resourceful conversation here. If you're a current client and want to add this to your plan that you already built out with us, really super easy and simple. So reach out to the team.
I forgot to tease this, GC.
What?
But we have a brand new section of the real estate market update that we're unveiling for the first time right after this, right? So you are texting Tierra right now if you want this presentation, you want to review this stuff, 904-293-0341. But Gregg has actually been working really, really hard to update us quarter over quarter how this community has performed, right? Like not just the JWB market update, not just the headlines and whatnot, but the Not Your Average Investor Show community report, GC. You ready to share this?
I love it, man. We spent about a year improving our reporting so that we had more insight, not just into the returns that we were displaying for our clients, but more insight into how those returns were generated and who is earning those returns. And it is the baseline for all this greatness I'm about to share.
Let's talk about it. Let's talk about it.
Yeah, to me, it's about making an impact and tracking the Not Your Average Investor.
Word of the year at JWB.
That is the word of the year. Absolutely. So here are our client performance metrics. We have about 1,100 turnkey clients that have purchased a little bit over 3,000 properties. Here's what's interesting. Their expected rate of return when they made the decision to buy those assets, largely between 9 to 12%. I don't think we've ever offered a property that's maybe more than 12% anywhere around there, right? But when you look at the actual rate of return for all of those JWB clients, they're earning 21% on average. Very cool. So we talk a lot about how under promise and over deliver is one of our core values. That's under promising and over delivering. And that's the type of relationship we think creates trust and continuity and lasting relationships that we want to have with all of our clients.
These are the folks on this chat that show up every Tuesday, that hang out with us, that ask great questions, that stay informed, that get the data plus perspective. 1,103 clients, 3,022 turnkey properties sold a 9 to 12% ROI, but averaging a 21% ROI. Now let's talk about what that means in straight cash home, GC.
Yeah, so this is the fun part. We're going to keep this this tally going, this tracking going of how many clients are reaching these thresholds. So we are so proud to have 3 clients that have earned over $2 million with their JWB rental property portfolios.
Nice.
I know them by name, and I know many. I know that I see one right now, and I'm sure the other 2. They're big parts of our community.
Yeah.
So it's not surprising that those who are achieving the most are the ones who are most engaged in this community. And we are super close to our 4th client reaching the $2 million threshold.
That's exciting. We should have a party for that.
We should. We have had 38 clients have earned over $1 million with their JWB rental property portfolio. We are up 2 clients, and this is since Q1 is the last time that I ran this information.
Yeah.
We have 162 clients that have earned over 500,000. That's up 4 clients since then, and we have 767 clients that have earned over $100,000. We're up 4 new clients that have reached that plateau as well. Total profits delivered for all JWB clients, all of you out there, is over $305 million. That is going to the most beautiful people I know that are going, it's going out there for beautiful reasons to improve your family, your community, the world. And we're so happy to be a part of it. And I also wanted to, again, this urgency, this opportunity cost of doing nothing, I wanted to put a spotlight on that too, because since Q1, those have been able to take action, bought those JWB rental properties, have earned over $3.7 million just since Q1. And guess what? That isn't even tracking their home price appreciation. We update values on an annual basis, and we do that largely in Q1 or Q2 of the year. So that's $3.7 million, not including any growth. And we know that the market has appreciated for our clients. So guys, so excited to be able to share this with you. I hope you all feel the success. It comes down to that impact, and it's the impact that you all get to have by having over $300 million to go and improve your lives and those around you.
So good, man.
Yeah.
$3.7 million since Q1 of 2024 in just cash flow by this community. I'm so pumped to have a couple shekels in there.
There you are.
As part of that. Super, super exciting. It just shows, the value in this community, right? Like, you are getting $3 million advice in this chat when you join us on Tuesdays, right? Like, these are the folks that hang out. Again, if you want a copy of the slides, 904-293-0341, so that you can look this over. Come back to the show with questions. Look over these slides. Come back to the show with questions. We do this every single Tuesday, right? You get to come here. You get to ask about the folks that are, have made $3 million this year in cash flow, that come here every single Tuesday. Ask them about their experience. Ask them about their different strategies, right? Every strategy is unique. So having that context is super huge. That's why this community is great. If you just want the info, you can find the podcast, Not Your Average Investor Show, on any podcast platform. You can find it on YouTube. It's live on YouTube right now if you want to go check it out. But more than anything, I just can't get over the idea that when you are doing this is a team sport, right? Like, you really, you might be the quarterback of your finances, but this community is your offensive line that keeps you protected, right? Like, this data plus perspective is the offensive coordinator calling in the shots, right? Like, not to get to I'm going deep in the football today. This Thanksgiving dinner is going to be your Super Bowl when you prove it to your friends and family. No, I'm just kidding. It's really special to be part of this community as we wrap up our last quarterly update of the year, head into Thanksgiving and all that stuff. Just really, really grateful to have been part of this, GC. I'm grateful to just watch you as a thought leader continue to develop your message. Came up with some new kind of insights of the fear market that we're in right now. I think that that's going to be words that will stay because there's 59 million articles that are suggesting that it's a fear market out there. And I think we're going to continue talking about that. I know that we went venue hunting for the Not Your Average Summit yesterday. So be looking forward to an announcement about that at some point in the next days. And it's going to be really fun. I'm really pumped about that venue, man. I'm pumped to see all these folks here in of next year.
Hey, thank you guys for being here. I mean, at one point we probably had 150 folks that are tuning in. That's a new record for us. I also did want to let you all know that we're doing another show tonight. It's our encore. So if this wasn't enough for you and you want to hang out, I know many of you did last time, you can sign up and register for the encore. Joanna, if you have a minute and you can post that in the chat, you can just go right there, tell your friends and your family if you think that this was helpful for you and that they could benefit. We would love to have all of you and all of your friends and your family be there. tonight. It's at 9 o'clock.
Text TR for the slides. Come up with some questions. Bring them to the encore. We get a little bit spicier on the encore, right? Because you're gonna have like 3 or 4 beers before. I'm just kidding. I'm just kidding. But we're gonna be there with a full belly. It's gonna be after dinner. It's gonna be for our West Coast friends and for our friends that can't join us in the middle of the day. You are officially registered for the show now because you've been here. If this is your first time, you're gonna get text updates. If you want those to stop, let us know. But we're gonna remind you because we show up here 12:30 on Tuesdays. We got a bunch of great shows coming up to wrap up the year, and we got a little bit of advice for you from now till then. What do you think, GC? Don't be average. See you on the next one.